the government doesn't produce any affordable housing. It builds at a more expensive rate than the private market, and then it either sells back to the community, which then just sells for market rate as soon as they remove any restrictions on that property, or it's a rental, Section 8 or whatever, but that's not home ownership. It's just you're going to see people cutting back on the discretionary spending when housing goes up. It's just how it's going to be.
This is the real estate investing experience. We get it. Real estate can be rough sometimes, and that's why we bring in the experts to talk about the experiences you won't hear anywhere else with your hosts, John Cohen and Chris Grinzik.
What's going on, guys? Welcome back to another episode of the Real Estate Investing Experience. I'm your host, Chris Grenzig. With me, as always, is John Cohen. How's it going, bud?
We're doing good. We got a couple deals shake free yesterday, 2 mobile home parks. I'm super excited about those.
There you go.
But other than that, just rocking and rolling, see what we can do.
I heard it's absolutely freezing up in New York.
It is very cold.
I was talking with my Oma actually, and she was saying it's like 20 degrees, and she was like, I don't know whether to go to church or not, all this stuff. And obviously she's 91, so it's a little bit different, but that just sounds brutal. It
is. It's been very cold the last couple of days. We're supposed to get some snow. I haven't seen it coming down yet, but it is cold.
It's a balmy 70 today. Down
there you go. We're actually going. We're going upstate this weekend, and it's supposed to be like -7. I'm like, oh, but the life of the Northeast, right?
I hear you. I don't miss that. I'm sure. Like I've said, almost probably every episode. I'm sure I'll be singing a very different tune in about 3 months. It's going to be very different. I mean, even today, just walking out, I wasn't wearing a jacket or like a sweater, just wearing like a shirt, basically. I was like, even this is a little warm. It's not going to be fun.
No, not what is now January. Yes, you're probably a couple months away before it is really humid and hot, which I do not play well in.
Yeah, once we start recording episodes in like May, I would encourage nobody to watch the video because you're just going to see pools of sweat coming off my face the entire time. If you hear little plops while you're listening to, that's what that is. So just ignore that in the future. But let's jump into today's episode. We got a really great guest on today. Somebody I connected with recently who's been helping me out as I've made the transition and has been helping me on the property and has provided a ton of insight. So I wanted to have him on to share with everybody else and learn more about him and hopefully pick his brain some more. And, I can apply it to my stuff. Hopefully you can as well, and anybody listening can as well. So with that being said, Dustin, thank you so much for jumping on.
Yeah, you're welcome. Thanks for having me.
Yeah, absolutely. So kick us off. Just a little bit about you, your background, what you do, and all that good stuff.
I am a multifamily investor. I started out as I owned a roofing company, and I slowly transitioned into building duplexes and owning them. And I probably should have stayed in that. I should have stayed in that sector, but I'm glad that I didn't because it brought me to multifamily. But I should have just stayed in the sector of roofing and then building to own, because when you build something to sell, it's not near as profitable. It's much more profitable if you build it, own it, and sell it later on down the road. But anyways, I thought the roofing industry was not glamorous enough or, whatever, even though it kicks off a ton of cash. A very good industry to be in. So I moved into the house building industry, which is a very hard industry to actually make money at. But I learned a bunch of stuff, and then I kept building and owning some of the assets, not as many as I would want to. And then I got to the point where I didn't have any capacity. I was burning out and I was doing way too much. I wasn't focused. I was working on affordable housing development, custom homes, custom home designs, and that takes a lot of your time. And then I was also developing mixed use buildings, and I was developing residential townhomes. So I was all over the place. And then I found syndication. I flew down to a Jake and Gino conference in Nashville in 2017. And I found syndication, and I was like, oh, this is it. And then I applied the syndication model to all my earlier investments. And I realized that single family homes are terribly inefficient. and I sold all of that stuff. And it's good to single family homes. I'm not dogging on them, but it's really hard to scale, and it's much easier once you get to your capacity. It's easier to get rid of the single family and move on to a more scalable asset. Mm-hmm. So then that's where I am now. All my single family stuff sold. I don't have any more liabilities on any affordable housing developments. I just stripped all my liabilities away. And now almost every one of my assets is cash flowing, which has allowed me to be much more passive, which is why you see me in all these cities checking stuff out.
Gotcha. So are you still doing any development work, or you're just totally in the syndication game now?
Well, no, I still develop, but I develop through a syndication model rather than through a JV model. So then I can keep my cash. I can bring in more investors. So I just apply the syndication model to the development. And then I also only develop the better. Before I would just, any opportunity, I would just jump in. Now I'm more picky at what I do develop. And I do think that developing right now, because in-place multifamily sales are so competitive, I believe that development is a very good option right now.
Mm-hmm. So it's interesting that you said that, because as I've transitioned down to Florida and looking at different things, at Toro, we would diversify by being in different geographic regions, but being in basically B and C class multifamily assets. And now I'm looking to not get too niche down and start to explore other things. And I am looking at things like small multifamily development, like obviously starting very small and then, working my way up just like anything else, or some self-storage. And it sounded like you got spread too thin, which is something that I'm aware is a possibility and I want to be proactive against. How do you feel that you just got into that space where you got spread too thin? Like how did that happen? And then what was a light bulb for you that like, hey, this isn't going to work?
The light bulb for me, I can just tell you where the light bulb was. The light bulb was I was working harder than I ever had in longer hours and doing more things, but the inefficiencies started piling up and I was not making any money. I was just flatlining. So it's the first time in my career where I was flatlining, but I was doing more than I've ever done and accomplishing a lot, but just to the point where, oh yeah, send that guy out there to do the job. Then you get the bill and it's twice as much because he didn't really manage that aspect. And that was what was happening. All these little, like death by 1,000 paper cuts, basically. So I was just flatlining. So I knew, I was like, well, if I'm not making money and I have all this stress, this doesn't make any sense. I gotta pivot. Mm-hmm. So that's what I did.
And when you were adding different things on, because I'm sure you didn't do all those different types of development, one snap of your finger and that was it.
Correct.
Did you start doing those other things because it was like the grass is greener type thing? Or did you have clients that were like, hey, would you also do this? Like, what was that process like for you?
Yeah. So I would once you start rising up, tons of opportunities will get presented to you. Everything comes to you. And I didn't know how to say no at that point. So I just said, yes, 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 because people will see that you're successful in one thing. So then they bring you another thing. And my problem was I was also in the construction. So I don't think that if you're doing multifamily, I think if you do multifamily, you can still do like self-storage, as long as you don't be like, okay, I'm purchasing multifamily, but now I'm going to start a construction company to build these self-storage. I think if you team up with someone that's the construction arm and you're still doing the same type of deal that you did in multifamily, just applying it to self-storage, that's okay. Mm-hmm. But I had a construction company, then I had a development company, then I had a asset management company, and then, trying to help the property manager on certain things. So you're constantly switch tasking. And when you switch task into a certain zone, your brain prefers to stay there and do the work. So you'll notice, even if you're doing work that's not quite as good or desirable, you'll notice that you still want to stay in that zone because you're getting something done and you're accomplishing something, and you don't even want to switch tasks to another job that is even actually easier to do, because it's like you have to reset your whole brain to do that. And mm-hmm. I was basically I was the bottleneck in the whole process. And that's when I realized that it was no good. But if I wasn't the bottleneck, I would just let it go through and then we wouldn't make any money. So was kind of like, I didn't have systems and processes to do all that stuff.
Mm-hmm. Is that because like you just felt you were getting too much too quick? You didn't have the time to dedicate to creating those systems and processes? Like you just piled on too quickly, or just something?
I actually am not a day-to-day guy, so I don't know how to do processes and systems.
Gotcha.
But if I'm involved, I somehow can figure it out and make it work. So anything I'm involved in, I can make profitable. The problem was I was involved in a bunch of things, but I couldn't give any of my time to it.
Mm-hmm. Gotcha.
So, but I am not a systems and processes guy. So I also learned that I need to partner with systems and processes guys. So during this time, I had also partnered with another visionary. When you have two visionaries and no operators, you grow super, super quick. And then that's when you realize something's not right. Something's amiss here.
Mm-hmm. So is that something that's been really important as you, because I think you do your own deals and then you also partner with other operators to help like co-GP deals as well, as right?
Correct.
Is that something that's really important for you as you look for partners, that it's somebody that really complements your skill sets and isn't necessarily, they could be the best operator or the best syndicator in the world, but if they don't complement you, you're not going to look to work with them?
Right. If that's the case, maybe I'll just be an LP investor. But if I come onto a team and I have nothing else to offer anyone, then there's no reason for me to be there.
Gotcha.
So if there's two people just like me on the team, that's kind of redundant and there's no reason for it.
Mm-hmm. No, it makes a ton of sense. Coming from that development world, as you've now stepped into the existing multifamily world, I don't know how much you dealt with like existing structures beforehand, but it sounded like everything you talked about was building or developing, or maybe on the roofing side you did a little bit. Do you feel that you have a very different perspective on the syndication world of existing multifamily than a lot of people because of that? Or do you find it's not such a big difference?
No, it is. It's a very big difference. It also, the development world opens your eyes to whatever is coming. So when you start developing, you have to pay more attention to what trends are going on in the design world. And that right there allows you to, like, you're seeing 5 to 10 years in advance. So you're not putting in old dated products into your multifamily right away. So we might not think they're old and dated, but next year they will be old and dated. So I get to see that, like, hey, here's what everybody is doing in this industry. And it's, it's kind of a trickle down effect. So I can see, okay, if people are coming out new designs, this is what the new design looked like. That means this design is probably good for 10 years. That means this design that we're using now is definitely on its way out. We got another year or two. And also I get a heads up on construction costs. So development costs, the multifamily, the existing in-place assets lag the market, right? The stock market does not lag. So right now you're seeing the stock market increase exponentially. That same increase should hit the multifamily sector. And I'm betting on it that it will, because it's already hit the development side. And if it hits the development side, 1 to 2 years from now, it's going to hit the multifamily side. So there's a ton of pent up appreciation right now in multifamily that's going to come. That's how I believe. And I can see these trends because I know what's happening with new construction. And I've been in new construction for almost 20 years. So this has happened. The same exact thing has happened in 2008. And it happened every time you get an inflationary spike, the existing market trails like 1 to 2 years behind. And you can correlate it directly to the stock market. So everything that's happening in the stock market is an inflation. It's inflationary. All the gains are inflationary. These companies some of them are making more money, but it's not necessarily because they're making more money. It's because they're worth so much more money because the dollar is devalued. But we just don't know it as a people yet. Nobody understands that our dollar is worth so much less. But the stock market tells us, the development world tells us, because it's real time. The multifamily market is not real time. It's all perception. So the perception of these inflationary periods has to come down to the existing before we'll see it.
Mm-hmm. So I hear you, right? I loosely, keep my eye or pulse on the stock market, but obviously I really am not tapped into the development world. when you say you see inflationary trends in the development world, what exactly is it are you seeing? Is it the cost of service, the cost of goods? Is it the cost of land? Like, what are you seeing that's being inflated?
Everything. It's all going up. So land is going up, and land is just more valuable because it's land. I don't know, but land is going up. The infrastructure in the ground is skyrocketing, and the labor costs. We're losing laborers. You do not go onto a job site and see that many young kids working on job sites anymore. You see 40, 50-year-olds.
Mm-hmm.
You don't see any 20-year-olds. Very, very, very rarely do you see young kids on the job site. And labor is continuing to be a problem. 2008 wiped out roughly half of our builders. They never came back. It's just not a glamorous. It's not glamorous. It's not a glamorous job.
Mm-hmm.
So we have a massive talent pool, or we have a lack of a talent pool. So where are all the workers going to come from that are going to do the multifamily or to build anything? So that's why you see this demand. So in 2008, there was like a 2 million surplus of units available to move into. And then when the most recent, I don't know, it was when COVID started or something, we were like 2 million units behind. Mm-hmm. So the fundamentals of the housing market are so different from 2008. They say 2008 was the worst ever. We built up the labor pool and then we completely decimated it within a couple years. So 50% left. Plus then there's no, the borders are shut down. So we're not getting any labor imported in. Just a lot of reasons why there's nobody that's willing to work, and where our technology is not even close to be able to build a house, like using a 3D printer. Mm-hmm. All the modular ways of doing it aren't really even that efficient. So we have nothing going forward. Like, what is going to replace all the labor? There's no mechanized, nothing's coming that I can see. And I've been looking at this for at least 10 years on how we're going to build houses easier, better, and with more tech involved, and to make it more of a passive build where not a piece of labor has to be done on every single part of the job.
Mm-hmm. Well, you touched on something interesting that I've heard also is, the young people not coming into the labor intensive jobs. And I heard about it on the maintenance side for the multifamily stuff. Our property manager in Florida was talking about this, saying that, your maintenance staff pool is just getting older and older and older. And there's not really any young people coming in to work in those fields because they just don't want to do it for whatever reason, whether it's, there's so much more technology, or people don't see it as, a valuable job, or there's not enough growth. I don't know what it is, but for whatever reason, the trend for several years, if not over a decade, has been less and less people coming into that maintenance staff. And we've seen it on our properties when we first got into Florida, and even just back then in general, payroll was, everybody would slap on $900 a unit, $1,000 a unit. And, obviously it depends on the size of the property a little bit, but, we've seen it gone as high as, $1,300, $1,400 a unit for the same property. So we've seen a very steep increase in the last 4 years. And a large part of that is the maintenance staff. It's also to just a low unemployment environment pre-COVID, allows for rapid increase in wages because everybody's competing for less people who don't have jobs. So it's that as well. But, they were saying like they were trying to partner with like local institutions that do a lot of this training for young people. And it's just harder and harder to get people in.
Yeah, we're seeing the same exact thing. You look at the maintenance staff, just go and look. Actually, if you want to look at the staffs, there's almost no young people. There'll be a few young people and maybe at the front desk. But even if you threw out the entire complex, when you get to these bigger complexes, you don't really see any young people working there. Very few.
Yeah. And I think it plays back into a bigger trend that we talk about is with a lot of newer investors, and it's frustrating for us, and I'm sure it's frustrating for them as well. It's like, how did you come to these numbers, or how do I know what to plug in for expenses, right? That's always a big conversation you have with people that are newer to the market, newer to the industry. And there's so many models or, rules of thumb that just people will say that don't really apply anymore because the market's always shifting and always changing. And it's really tough to have that conversation with someone and be like, hey, I can't tell you, right? Like, it depends on your area. It depends on the deal. Like, those things change. And there's a good chance you're going to be wrong in a couple of years anyway, right? If we had bought a deal in 2016, we were going to grow $1,000 a unit probably at 2% a year, 3% a year. That's not going to hit a 20, 30% increase 3-4 years later. So we would have been wrong. It's just a really tough conversation to have. And I think it's something that a lot of people struggle with as they get into this industry to understand. I think this is just a really good example of that.
Yeah, I always say you should have a lot more money than you budgeted for labor costs, because that's usually, they can just get out of control quickly. And then if you tail off your labor, then your complex starts to look like you're not taking care of it. It deteriorates a little bit more.
Mm-hmm. No, for sure. So what are you looking for as you look at properties? Like, are you looking for properties that need a lot more work than a lot of people are looking for? Or are you looking for stuff that's very stable? Or are you looking for like smaller things that were done correctly that are very, very tough to change? Because I know when we were looking at this 16 unit, my dad has a good deal of construction experience and stuff like that, just building some stuff himself, probably not to the same level as you, or not as applicable, but knew more. And he pointed out a lot of little things to me that would have been very tough to change or redo in a 6-year-old building that he's like, oh, they should have done this, they should have done that. And it might just be poor building, or it might have just been at the time. Do you look for any things like that as like a good base to build off of, or it's just, it kind of is what it is?
Yeah, it kind of is what it is. If things are designed wrong on the complex, there's really nothing you can do, but can you make it work? But I tend to, if I walk the complex and I don't like it, just walk away. It's not a big deal. Mm-hmm. That's how no deal is that big of a deal. And so if I feel like the complex is not desirable, then why would the tenants think it's desirable? Then you're dealing with way more turnover, and just walk away and go to the deal that is desirable. Mm-hmm. I'm just not, I don't know, maybe it's just my position, but when I've got to this point where no deal is important and you can just let every deal go, you get way better deals. But I'm looking more for, I don't want a completely rundown, tons of deferred maintenance, because that you start realizing like so much deferred maintenance, you don't know what you're going to run into. You don't know, how did they actually fix the boiler system? How did they actually, did they ever fix anything right? So, and then I like more stabilized properties. I just like poor management is my favorite to take over. Someone that's not using any tech, that's using the laziest property management company, that doesn't yell at their property manager. Not they have to yell at them, but squeaky wheel always gets greased. So they might just be, they had the property for so long, they're fine with their returns. They're not really paying attention to it, but they take really good care of the physical asset, but they don't update it. That's what I'm looking for. Like they did a really good job. But then also location's the most important part. If I look and I don't like the location, I just pass right away. And then I go to the other things, but also you have to have a good operator. If I don't like the operator for some reason, the deal doesn't matter at all to me, because the operator will make or break any deal.
Mm-hmm. Yeah. You touched on a couple good things I think are important, right? Anytime you come to a negotiation table for anything, if you are in a position where you can't walk away, you have very little leverage over that other person. So anytime anybody's looking at a deal, if you feel like you're in a position where you have to buy a deal, that's not a good position to be in. So the ability to say no or walk away from a deal is super powerful and important. And it should happen to you several times or multiple times over your career. We've put deals under contract that we've walked away from after we found certain things. Some in hindsight, we maybe should not have walked away from, but some in hindsight, we, were right to walk away from. So, it's easier to look back and have more information and see how you might have made a different decision. But the ability to walk away from a deal is a significantly better tool in finding a good deal than having the best underwriting skills or having the best market knowledge, because it's very tough to lose money on a deal you don't buy. It's it's very easy to lose money on a deal you do buy. So I think that's really powerful. Also, you said something about walking on a property and it being desirable. Is there anything specific when you said that, or is it just like an overall feeling you get of like flow, design, and stuff?
Yep. So yes. So you have to listen to your gut. And this is like, if you're a rookie investor, your gut is going to be the most strong, your best. It's going to be your best intuition, because you don't really know much about what to look for physically or this or that. Just feel in your heart what you feel, and then that will be your decision. So if you're walking a complex and for some reason you just don't want to be there, that's what your renters are going to feel too. So they're going to leave. So we were walking a property in Mesa, and it was not that special of a property, but the way it was laid out, and they did just the peacefulness about the complex, it felt like you were in a Japanese Zen garden. And even and so I mentioned it, and then my partner that was with me said the same thing. And I was like, well, who wouldn't want to live here when you get this type of feeling when you're walking the grounds? And then it was also right across the street from the police station. So it was super, super safe. And then you had this Zen-like feeling when you're walking the grounds. Well, anyone's going to want to rent there. They won't know why they're feeling this or what's going on, but they feel really good when they walk in, and they feel good when they tour the property. Now they don't have a reason to actually want to exit the property. Mm-hmm. So I take that all into account, and your subconscious actually processes like 95% of the information versus 5% for your logic brain. So when you're trying to figure out everything with your logic brain, you miss the majority of the inputs. You're not taking into account what your body is taking into account. So listening to your gut is super, super, super valuable information, and your gut is almost never wrong. That's what I've learned. Your gut's almost never wrong. When you do a bad deal, you ignore your gut for the most part, and you just carry on because you think you need it, because your brain's telling you need it. Your logic is telling you why you need it, and your logic starts to justify why that's a good deal. And then when it's just like when you're holding something, right? You're going to hold this thing, and you're like, hey, I'm going to hit my thumb with this hammer. But you're like, well, I got to hit this nail in here. And then you hit you're doing something that you shouldn't be. Like maybe it's a little odd position, and then you smack your thumb, and you're like, well, my body told me I was going to smack my thumb. That happens quite a bit, where your logic will override your subconscious, and then you'll do exactly what your subconscious told you that you were going to do.
Mm-hmm. I talk about that all the time. I say that, you can be the best underwriter in the world, the worst underwriter in the world. You could be the best at finding deals or the worst. There's something about real estate that is a feeling you get when you are there, driving the location, driving to the location, from the location, driving into other comps. That is such a large piece of this that if you don't do, well, then you're probably making a major mistake. And if you do it, you're probably the deal probably works out better, because, when you drive into all the comps, you say, look at this, like nothing special about this. There's no grand entrance, whatever it may be. Then you drive into your site and say, okay, well, this is really, I get it, right? It just makes sense. But that component, to me, I say that all the time. It's a large chunk of good, bad, and different. I don't care what the piece of paper says. It's got to check off the boxes. Additionally, it's got to have that component to it, because that component is more important than almost anything. Because, like, you're 100% right. You're gonna know if good, bad, or indifferent. As you get more experienced, that helps. But you might also know other things that you can save money on this, and I can get a better service contract, and I can manage it better. But at the end of the day, I remember the first property I toured, I drove out front of it and I was in love with it. I said, oh, wow. I mean, could it get any better? Now, little did I know there was a lot of problems wrong with it, but at the end of the day, that feel is such a big importance that most people don't talk about. Most people talk about cap rate and interest rate and rent growth and renovations, but that's all important. But there is a feel to real estate that you need to have.
Yeah, I think a couple good examples of two really good ones I can think of that are both good and like not bad, but also good was we bought Parkett Blanding down in Jacksonville, and I walked on that property and loved it instantly because it was almost like a tiny village. It was like set back off the main road, and it was 1 and 2 story construction, but everything was very spread out. A lot of trees, a lot of green, and it was built with like very low units per acre. I think it was like 10 or something like that, which, you know, oftentimes I think garden style is like 15 or more, something like that. So it just felt like a really nice, almost like community or town, or like this mini little village where it was just nice. It was quaint. There wasn't a lot going on. It was, you know, kind of sleepy. And it was just the type of place that, because the area had pretty good school districts, because it was only 2 and 3 bedrooms, I was like, this is going to be a great option for people that want to rent, go to these school districts and either have a family or are starting a family and don't need a house. So for me, it was something that I just thought made a ton of sense in the hemisphere that it was in. Another example that I think plays into that as well is a deal called Park at San Marco. That deal, if you come out of that property and you go right, you start going towards the older part of town, and there's tons of older properties, tons of flips, tons of really nice properties, and it continues to get better, better, and better. When you come out and go left, there's just down the road some really awful retail, and there's actually a gentleman's club around the corner. If we could somehow force all of our tenants to come from the north, come south, and go into the property, I know that property would do way better than if people were coming from the south, coming up north, and turning into the property. Unfortunately, coming from the south comes right off the highway and is definitely quicker on everybody's GPS. So I know that, unfortunately, that property, today at least, maybe in the future that pocket gets better as it continues to, you know, gentrify a little bit coming south. But today, that's the retail that people are going to see. So it does limit that property to a certain degree, even though there is, you know, brand new built houses, like not even flips, like just brand new built houses on the back side of the property that just sold for like $200,000. So it's just one of those unfortunate things that you can't control, but it comes back to that feeling you get with the property, you know, as you go to it, as you get on it, as you experience it, it all ties into it. What do you think about you're talking about inflation a little bit too, and I was thinking about this as you talked. Does that have anything to do with like all the debt that has piled up recently with the COVID and stuff, or do you just think it's an inflationary period? Like, are you looking at that relationship at all, or it's just a trend you've seen and you don't really know necessarily?
No, I'm looking directly at all the money that they've printed. Mm-hmm. Like, your debt is, what is it, 27 trillion we're in debt or whatever. They just printed like $6 trillion. That seems like a ton of inflation to me. Mm-hmm. So, but you just, and it's not just, they printed money. It's everything that I look for. So I look for inflation. I think a lot of people want to bury their head in the sand and say, oh, gas isn't going up very much, or whatever they want to say. But I'm looking at raw materials. I look at wood. I look at copper. So I'm looking at all these prices all the time. So if you want raw materials that are worth a lot of money, if I bring in a roll of copper into my garage, I can sell that roll of copper later for the same amount I paid for it, or way more. So I'm just looking for those kind of assets, not just, you know, computers and junk that you're just going to throw away after it's old. But food, look at food. There was like a 3.9% spike in food in December, it was 1 month. It was the most recent month. And normally I think you do a 3.9% increase in food. I think the last one was for a full year. They had a 3.9%. Mm-hmm. And even that is high. It's normally not that high. So what they use for metrics of what the government uses for metrics of inflation, in my opinion, is BS, because it's a bunch of stuff that's not even necessary. But look at the stuff that you need to live on. Look at the stuff you need to build shelter, all that stuff. It's all skyrocketing.
Where do you look to find that information? Do you just go on Google and search inflation for copper, or are there certain places to see it?
I don't actually look it up. I just pay attention to people that post about it. So if they're posting about it, I take that information into context, but mainly I just price stuff a lot. So in development, I'm always pricing. I'm always looking at, okay, so housing is going up a tremendous amount. Well, that's a very desirable asset for people. So they're realizing, oh, wow, I better get a house now because they're going up at a rate of like, I don't know, they just jumped 30, new construction prices jumped about 30% in like not even a 6-month period last year. Now it's flatlined now, finally a little bit, like it's hit this spot, but it's not going to stay there. It's going to keep going up. No one's traveling. No one's spending any of their money on any of this other stuff that's not necessary, but they are spending more now on what is necessary.
Mm-hmm. So how do people afford a higher rent if nobody's working? And the labor pool is tough. Because inflation, people and everyone in the multifamily world say, well, inflation, I'm going to grow my rents at 4% and 3%. And I'm going to, my rents will go up in an inflationary period, which historically that's the case. But with lack of employment or shitty employment, how does that impact, the rising cost of construction, the rising cost of everything? How does that impact a decision someone to make?
So people aren't going to be able to buy that house anymore. So now they're going to go to an apartment instead. So people are getting priced out of housing dramatically. It's very quickly. It's dramatic how quickly people are getting priced out of housing. So my brother-in-law is a manager at a store, and he's been there for a while at a J.H. Larson. So it's a pretty good position. And his wife's a pharmacist, really good position. They're having a hard time finding a house. So if they're having a hard time finding a house, they're like the perfect start. You can't get a better starter home buyer. They're having a hard time finding a house. And I hear it's like this in every market, every desirable market. You can't buy a house. It's very, very, very hard. So that just means that a higher percentage is going to be spent on their rent. They're not going to go on vacations as much, which has already been cut. Not going to go out to eat as much, which doesn't matter because food is skyrocketing. So your food's just as expensive. Eating at home is just as expensive as going out. If you go to the grocery store, you'll notice how much food has just went up. So you just spend more on the stuff you need. So all your discretionary spending is going to start going to rent. It's going to be more European, where less people buy houses, more people are, have to rent. There's not as many options. People probably won't move as much.
Mm-hmm.
I could be wrong on that. But I know rent's going to go up. It has to.
Mm-hmm. Have you seen what's the trend been like in the development space? Has there been a spike in the number of new housing units coming online? Has it really slowed down with, COVID and, some of the pricing increases? I'm sure it's thrown people's budgets and plans way off. Have you seen any sort of trend that way?
It's not that people are building more. It's just their stuff selling instantly. So they might be building a little bit more, but the stuff selling instantly and there's no inventory. Mm-hmm. So there's just no inventory. I mean, maybe there's some inventory in the higher end levels, but even there, I don't really think there's a whole lot of inventory.
Mm-hmm. I think too, one thing that as we talk about that, we all think about, and I don't know if there's a right answer for it, but as these older assets continue to trade and rents go up and up and up, there just continues to be this gap of affordable renting options for people who need it. Do you have any idea or any thoughts on how that's going to impact the market, or, how that's going to be addressed going forward? Is it, mobile homes are going to be more attractive? Is it going to be, there's going to be, greater affordable housing incentives and grants? Like, do you have any thoughts in that regard?
Yeah, the government's probably going to try and get involved more, which they don't do anything good. They've been trying to solve affordable housing ever since I've gotten into the build development realm, except for it was like 2010, 12, maybe 13 is when it really got hot. But they'll try to do something. They can't fix anything though, because the government doesn't produce any affordable housing. It builds at a more expensive rate than the private market. And then it either sells back to the community, which then just sells for market rate as soon as they remove any restrictions on that property, or it's a rental, Section 8 or whatever, but that's not home ownership. It's just, you're going to see people cutting back on the discretionary spending when housing goes up. It's just how it's going to be. Same with like our food costs, right? We Americans traditionally have like the lowest percentage of our income going to food. Well, that's going to change. Our percentage of food's going to go up. We're going to have to cut in some other stuff. So there's a lot of discretionary spending that Americans could cut. We're super spoiled as a people. Like, we don't need all the shit that we have. And that stuff will just get cut out of the budget because you're going to have to pay rent. Just going to have to. You can't cancel rent. That doesn't work. If we cancel rent and there's no rent for people, then the buildings will deteriorate immediately and people won't want to live in them anyways.
Mm-hmm. No, I think that makes a ton of sense. So how are you looking at the future of the market then? Because I think one of the things that we struggle with is, cap rates have come way down so much over the past 8-10 years. And, we talked about a deal we bought or looked at buying in Indianapolis that was selling for 6.5. We underwrote to a 7.5 and it just sold for like a 3. The NOI actually went down over the 4-year period.
Yeah.
Extreme example, but how are you looking at the future of deals on an exit? Are you going short term so that it's a little bit easier to potentially predict? Are you going longer term as like, hey, we don't know exactly what's going to happen with the market, but we think it's going to be a rising market? What are your thoughts there?
So I invest with different groups, and some groups I invest with, they want to sell. So they're putting more bridge financing on because the market is going up. If their bridge finance, hopefully they get a long-term option with the bridge, although they might just have to refinance later. But I'm always in real estate. If we can't sell it, who cares? I got a great asset. Like, let's just refinance it. Hopefully the markets aren't completely shot when that time comes, but I am if the asset doesn't sell, you should always be prepared to own that asset forever. It's not like a stock where, we'll cut our losses and dump it. If you own the asset forever, well, from my experience, it's always worth more. Go back through history, and when has land been worth less? It's worth more now than it's ever been. Apartments are worth more now than ever been. Also, we have to realize that these investments should be closer to a 10%. Like a 10% is like the benchmark of what assets should make. So we're right now at, like, if you get good deals, you're at like a 20% return on multifamily. Well, the stock market, a great return is 10%. So this is and this is less risky. So this needs to come down until it's at the 10% rate. So these cap rates are going to continue to get compressed until we're more in line with a 10% return, especially when they're an asset that is more liquid. If you have a saleable asset, say in a big, huge metro area, if the metro areas hopefully they come back. When they come back to normalize, those metro areas, they're easy to trade hands. And that's why they trade at low caps.
Mm-hmm. Gotcha.
So anything that's liquid should be closer to a 10% return. And that's the mean that this is going to get pushed to, in my opinion, because the United States real estate is the best hard asset you can really own as far as risk goes. If you look at historical risk.
I talk about that all the time, real estate don't get me wrong, it's returned millions and thousands and ridiculous percentages to people. But historically, taking debt off the table, obviously, the cap rate on this space is not 3, right? It's higher than that. But At the end of the day, that view, you're not really going to get burned because you can't. And I will question anyone that you can't find a 20-year period or probably a 10-year period where if you bought something and held it for 10 or 20 years, it was worth less than when you bought it. I don't even care if you started in 2009 to 2019 or the Great Depression, if you bought it right before the Great Depression and 10 years later. So at the end of the day, if that's the viewpoint going into whatever the opportunity, okay, if we can refi if the market shit at that point, hopefully we can at least put new debt on it if we have to. But if you go long, you're not gonna lose. You'll be just fine and probably happier than ever as long as you have that mindset. When people want to be in and out and trading these things like liquidity, like stocks, that's when you get caught with your pants down sometimes. Maybe not over the last 7 years, but that view on it, typically is going to reverse the course to disaster.
And you have to remember that the operators and the acquisition team is the team that wants turnover. The investor doesn't need turnover. The acquisition team needs turnover so that they can show they're going full cycle. They can get their acquisition fees. They get their refinance fees. So there's a lot of fees involved. The brokers need turnover. So there's a lot of people that need turnover. So there's a lot of turnover, but the investor doesn't necessarily need turnover. They think they do, though. So they think they need turnover, but it's expensive to buy and sell properties. Very expensive. So the investor does not necessarily need it. Unless you're with, I mean, if there's just tons and tons of opportunities and you can create, you can turn the flip into as soon as you turn it to a yield play. Yes, you want to sell it instantly and get into another value add. But that being said, if the investor doesn't necessarily need it.
No, I think that's important because I think a lot of people now, as deals are being bought and sold so quickly, I do think there is somewhat of a trend of investors like not necessarily wanting to be in it long term, and they want to be in it so short term to like, get their 2x multiple in 2 or 3 years because they've heard this crazy deal that did it in a short amount of time, and they're trying to double their money super quick. And I think that's just not what real estate has been for, the long-term trends like you guys are talking about. It's really built for the person who, there's a very good chance that can happen, but this is something that's for the long term. It's going to spit off some cash flow. If you don't have, 7 figures invested, it's probably not going to change your life in terms of what the cash flow is, unless you're going to live on a very little amount of money. You're not making probably 10, 15% cash flow every year. You're probably making in the 5 to 8 range, depending upon the asset. So, I think there has been this trend of like, oh, we sold this deal for, 100% return in 2.5 years. And that's great and all, but I don't think that's the long-term trend. And I think it's just going to continue to be tougher and tougher and tougher. And people's expectations need to change as this market continues to rise rapidly, cap rates compress, and like you said, start to be more competitive in line with the stock market in the US.
Well, yeah, look at all the money that's come in from hospitality and retail. Who's investing? Who's building any new hotels? Who's investing in the hotel? Only people that are investing in the hotel now are the ones taking huge risks that really know what they're doing, and they have a huge stack of cash behind them. It's more of a long-term, sort of a risky play, because what happens if the hospitality doesn't come back for 3 years? You underwrote it coming back in 1 year. Same with office. Like, I don't understand the metrics of office right now, specifically for the reason the best office space in the world in New York City is completely empty. Mm-hmm. How long can that actually go on for? These corporations are having record profits by sending their people home. What's the point of coming back, opening the office up, and then opening up all this liability? And I don't know. When does the office space even come back? And is the office space going to be all socially distanced now? How does that affect the office space? I don't know. Is it even worth bringing back office space with all the stuff that you're going to have to supposedly do?
Yeah, no, I think it's going to be interesting. I think I saw something where Cuomo said he was going to be open to more redevelopment of existing structures like hotels and office into more residential housing units. And I was speaking with somebody that they're looking to start, I think he was on the podcast actually, looking to start or have been, redeveloping hotels in residential areas in Manhattan to start redeveloping into actual apartments or housing units for people to live in, because it makes sense.
But where are the people though? So, and who wants to live in that environment when there's no stores open, there's no restaurants open, there's no place you're not going anywhere. Mm-hmm. The people are gone. Someone sent me a picture of downtown New York City, and it's Friday at 10:30 a.m. and it's completely barren. There's 4 people in the sidewalks, mm-hmm. and there's buildings that hold millions of people in view of the picture. Well, where are all the people? Mm-hmm. And why would they come back to live in a converted hotel?
I think it's, like you said, more of that where people are looking at the hospitality. It's a little bit of a longer term play. I mean, I firmly believe New York is going to bounce back. People are going to go live there again. If it's ever going to be to the same degree, I have no idea. Obviously, I think it'll change somewhat in, how people live there, how hotels, stores, offices interact. But I mean, people want to live in New York. People want to go there. Tourism is going to pick back up. It's going to happen at some point. When exactly it happens, I don't really know, but I can't imagine nobody going back.
So I also,
it's just like when, Brooklyn was dangerous, right? You wouldn't be caught dead in Brooklyn, right? It was a nightmare. I mean, even when I first started doing real estate, and I helped someone move into an apartment in Williamsburg. I asked a friend of mine who's, he's 60 years old at this point. It was his niece. I said, "Why don't you come? You haven't seen your niece in a while. Why don't we go drink?" He's like, "Who? Are you crazy? I grew up there. That's dangerous." And we drove there. He was blown away. So, yeah, it's going to come back. Is it going to come back tomorrow? No. But at some point in time, New York will be New York. It's just, it's just what happens, right? It's just how it goes. It's not just going to go into like a barren wasteland like Detroit was for such a long time, but it's only a matter of time. So if you have that type of capital and you can go long, you're going to be very well off in the future. Just, you got to be prepared for a long haul.
Yeah. So speaking of that, Detroit, well, Detroit's still not back.
True.
Why is that?
Well, all the automakers are gone and they don't want to be there.
Right. All the automakers are gone. So what happens when you don't necessarily need to be in New York anymore to do your financial? All of a sudden, it's not a financial hub anymore. Then what is it? And if the people's attitudes, they're so scared to get near anybody. Our brains have already changed. It's just like how the Asians have changed. It's in the Asian culture, they all wear masks and they all socially distance and they're all, they stand apart, although not in Tokyo. But are people going to be comfortable being shoulder to shoulder? How long is it going to be before people are actually comfortable being shoulder to shoulder with people? That's what I want to know. They're completely uncomfortable with it right now.
Yeah, there was a huge report last night on the mass transit in New York City. People are over COVID. Now it's dangerous to go on a subway because the quality of people you run into, it's not what it was when people were commuting. So, there's I think that Schumer was talking about like a $4 billion ridiculous amount of money that's allocated in the next stimulus package to protect people from commuting because it's become dangerous. But I agree 100%. I'm a huge believer that the day of needing to live in New York City or 20 minutes away by train because that's where your office was. Well, we've just learned that you could be 2 hours away. Maybe you only have to go into the office once or twice a month. So I think there's, if you can follow that trend and more space, more land, or whatever it may be, and you don't have to be in a major city. I mean, California's seeing a mass exodus to Arizona because there's almost no point of living in California. It's got a high tax. It's got a high, doing business there is horrible. And it's expensive to live. You pay a 16% tax because you have good weather. Well, people realize that Arizona is not too bad. So people are leaving major cities. Do they come back? I believe they will. It's just going to take some time.
Yeah. I wouldn't say they're not coming back. But when I look at stuff like Detroit, that was like that was the best place at one point in the nation. It was the best place in the world to live, or in the United States to live, maybe in the world at one point. Motown, all that stuff. Place is dead. They keep talking about how it's coming back. It's not coming back. They're just raising houses and putting like suburban farms in, or urban farms in. I don't know. If Detroit doesn't come back, there's a huge possibility that New York doesn't come back. Not saying that it won't. Maybe it comes back bustling, booming, but there's also a possibility that it doesn't come back, and technology just allows us to live wherever we want to live. And it's going to shift to all. So there's what Warren Buffett said, small business is business of the future because tech is advancing so rapidly. They're the only ones that are going to be able to pivot in time. And the big businesses will not be able to adjust all their systems and processes through their whole corporation. By the time they get that done, they got to readjust them again.
100%.
It makes a ton of sense. I think it's super interesting, right? I think we're in a really unique period, and it's going to have a lot of different changes on how we live our life and how trends in real estate is going to be affected. So I think it's really important for everyone to continue to be hyper aware, look at different trends, be up to date on what markets are doing, where people are moving, why they're moving there, how different materials are changing. I think it's all important for every investor to either, do their own research, or like Dusten, follow people that, specialize in different things and can relay information and really help you understand what's going on. Cause I think it's only going to be more important over the next couple of years as things continue to change, shift, and grow with the changing times. But I really think that's a good place to wrap up, unless anybody has a last little message. But yeah, go ahead, Dusten.
One thing. So if New York City needs as much tax as they need now to pay for pensions and infrastructure, when the wealthy people that decide, it's not worth it anymore, and they make the decision just to move to Florida, take their money with them, and just live a little easier life, because it's not easy to live in New York City. It's a very hard city to live in. It's tons of energy, no nature. So it's not easy to live. They're very expensive, hustle and bustle. Nobody gives you the time of day because you're so anonymous. So if, with all that said, and people do leave, say 10% of the people leave. Now that increases taxes how much more on the rest of those people? Like what, 12 or 15%? What if it's high wealth people that leave? Well, then what if their taxes go up 50% on the people that are there? Like, how is that sustainable? How does that infrastructure get taken care of? Or does the federal government just bail them out? Like, I don't know.
So it's an extremely valid point. It's already been proven out. In our Toro newsletter in January, there's an article in there that, Tribeca is one of the most expensive places to live. They've already seen through 2020, the average income of someone living in Tribeca was $140,000. And maybe I'm off by a couple bucks. But what they've seen is that those people have all left. The average income of people moving in is less than $70,000. So the average income of the person living in Manhattan right now and moving there is significantly less. And the city's lost a ridiculous amount of money. But I don't think it's physically possible for people to move back, and the tax increase and I don't think that is going to fix the problem. I don't think it's possible. I don't think there's enough money. People are going to leave. It's most likely going to have to be a federal or some type of bailout, because the amount of money that was lost that all the restaurants and all the hotels and all that stuff generates is too high. And it's been a full year. I mean, I have extremely close contacts and friends in the hotel business that have mailed it in. These guys are 20, 30 years in the hotel business. They said 10 years before we're even relatively close to where we were, because it's just unsupportable. So the point you bring up is extremely valid. And through 12 months, we've already seen it happening. So it's crazy to see, how that's going to play out in the future, which is why we're not buying anything in New York, and we're trying to buy stuff out of state just to follow the trends of people.
So what you said is, the people that were there making 140,000, well, that half of that goes to tax. That's 70,000. People that are moving in, they're only making as much as the tax that was paid from the previous people.
Correct. It's astronomical. I read that article. That's why I shared it with all of our contacts, because it's a real thing to understand, because it's bad. I mean, that's one of the biggest negatives out there, but all the positives that are happening and the trend of people going places, there's still so many bad things that people, I don't want to say aren't talking about, but it's sort of like swept under the rug. And maybe that doesn't impact most people, which is fine, but those things have to be shown so you can make a decision on where you want to be, where you want to invest, how you want to invest, and what your outlook is on the general market. So, but you're right. I mean, if you just look at the dollars, maybe it's 80 and 130, right? I don't remember off the top of my head, but it was shocking to see. You didn't expect it to happen so quickly and such a drastic change, but now people are getting, people that never were able to enjoy that, but enjoy it with air quotes, because there's not much to do, can take advantage of cheaper living in a place that they always thought was too expensive.
Great place to wrap up. Dusten, thank you so much for coming on and sharing your knowledge and insights. People want to learn more about you, get in touch with you, follow you. Where can they do all that?
Hit me up on my LinkedIn page. I'm there all the time. I do have a website, mailboxmoneyre.com, and mailboxmoneyre@gmail.com is my email address. You can always email me, but DM me on LinkedIn is the easiest way. I accept every single invite too. So if someone just puts a message in, if they need to invite or they want to get an invite, they can put a message in with that. I read every single DM. So I might not get back to you instantly, but I will eventually get back to you.
Awesome. Yeah, guys, definitely go check him out. Dusten Hendrickson on LinkedIn. Go connect with him. Puts out a ton of good content and a really good person to know. But thank you guys so much for listening to this episode of the podcast. If you're not already subscribed, it would mean the world to John and I if you would do so. And if you are, please send it to someone that would get a tremendous amount of value from this episode. Dusten, once again, thank you so much for coming on. This is awesome.
Thank you. Appreciate you guys.